Don't let what-if scenarios keep you up at night. Let's build a financial safety net for your family that actually covers them. Today, we're diving deep into determining the minimum insurance coverage your family truly needs. This isn't about selling you more. It's about smart protection. First, let's tackle income replacement. Imagine one of the primary breadwinners is no longer there. How much of their income would your family need to maintain their lifestyle? A good starting point is to calculate 10-15 times their annual salary. This provides a cushion for immediate expenses and a period of adjustment. Next, assess your outstanding debts. This includes your mortgage, car loans, credit card balances, and any personal loans. You want to ensure these aren't a burden on your surviving family members. List them all out and sum them up. Now, consider future education costs. Many families prioritize their children's education. Research the projected costs for college or university for each child. Factoring in potential inflation, even a basic estimate helps in calculating your insurance needs. Don't forget ongoing living expenses. This covers the everyday costs of running a household: groceries, utilities, healthcare, transportation, and any other recurring bills. Multiply your current monthly expenses by 6 to 12 months to account for an emergency fund and transition period. The minimum coverage is essentially the sum of these essential figures: your income replacement, total outstanding debts, estimated future education costs, and your emergency living expenses. This gives you a baseline to work from. Review your existing policies: Y-Euro life insurance, disability insurance, Y-Euro, and see how they align with your calculated minimum. This exercise helps you identify any shortfalls and make informed decisions about increasing your coverage to provide that crucial peace of mind.